I mean, we've got to remember who appointed Powell, and of course I think, you know, he's going to be sensitive to that. But and given that Trump did appoint him, I think he was quite clear that he said that open economies do fare better. But I don't think he's probably willing at this stage to say too much more. And I think that's probably the case with most central bankers. So, for instance, if we look at the RBA minutes that came out this week, they also cited trade. Australia, very, very sensitive, I think, to China and therefore to the whole US-China trade wars theme. But I think for central bankers, I think for all economists, for everybody involved in the market now, we're in the same position. We can look back at the data that we're seeing, that's backward looking, and see some really strong data. But looking forward, we've got this big cloud of trade wars, and we just don't know to what extent that's going to affect the global growth.
Yeah, look, we're month 7 of the year now. Month 8 is pretty much useless August because people head to the hills. So we are getting very, very close to 2019, and 2019 is the year where I'm hearing such diverse opinion from actually this is the year we go into recession, this is the year the stock market turns, to actually things could really pick up on the inflation front, and actually the Fed needs to be as proactive, if not more proactive, on rates. So where do you sit within those two extreme scenarios?
Well, you know, I think if I were in Powell's shoes, I'd probably be doing exactly the same as him, suggesting that, you know, you've got to follow the line that they've been set at the moment. If you look at the data that's coming out, we look at, for instance, retail sales that came out this week, if you look at the results from most companies, then you would look, if you consider just the data that we have, that yes, they should certainly be hiking. But I think if we look at the shape of the yield curve over recent weeks, if we look at what many economists are frightened about, it is how much trade wars are going to affect the US economy and the global economy. To what extent is that going to push the Fed off the path? And right now, we just don't know.
Even though he said that the risks, the outlook are fairly balanced at this point in time, I want to ask you what you think, what you make of the for now statement when he said this means that gradual rate hikes remain appropriate for now. Are they still trying to preserve some optionality, still indicating to the market that the path from here will be definitely still data dependent, or is it just a matter of, you know, keeping market expectations intact in case the data does start to disappoint again in the future?
Well, you know, I think for all central banks, they do have to remain data dependent, and I think that's sensible. So, you know, the for now is quite interesting. It does suggest that there is a little bit of doubt about the plan, but I think it's normal that there should be some doubt about the plan. I don't think a central bank should be so committed to a certain path, you know, 2 years or 1 year ahead. I think they need to give some guidance, but clearly if the data does deteriorate, they need to be flexible to that.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.